Okay, so 7 o'clock, here we go. Hope everybody's doing well today. My name's Steve Misic, and I am an instructor for the Online Trading Academy. The Online Trading Academy, of course, is a school that's been around for quite a few years, and what we teach at the Online Trading Academy mostly are all the assets, all the different assets that are available to trade. Stocks, equities, mostly in the U.S., but we do trade equities in other parts of the world. Futures contracts for people interested in trading currency futures or trading index futures. We teach classes on that. We also teach classes on how to trade the foreign exchange, which is what we're going to talk about here in just a couple of minutes, and we teach students how to trade assets called options. So if you've had a chance to watch part 1 and part 2 of the methodology that is behind the way that we look at markets, which is what we call our Online Trading Academy course strategy, or if you've had a chance, and I'm sure many of you have, to attend webinars given by our Director of Education at the Online Trading Academy, Sam Seiden, then you pretty much know that our philosophy is pretty simple. We want to teach our students to buy where banks have orders to buy, large institutions, and we want to teach our students to sell where those institutions have large orders to sell. And of course, we believe that price moves to where these large areas of buy orders and sell orders are. And kind of the reason for that is because somebody gets a chance to make some money if those orders get filled. Those unfilled orders will generate commissions for brokers. They will generate spreads for dealers. So there's more or less an incentive for price to get to areas where those big orders are to buy and sell. So as far as this goes with the dollar versus the Japanese yen, this is an asset that's part of one of the 7 assets that I follow on my blog every week. And we've been following the first few years of what I call a cyclical bull market rally and a very, very long-term secular bear market. This began back in May of 2012 to where the dollar versus the Japanese yen went from as high as 360 to the Japanese yen. I could get 360 Japanese yen for one of my dollars, to a low of around 75 Japanese yen for one of our dollars. And when it bottomed, it finally began a long period of sideways trading before breaking out into this current bull market phase. And the current bull market phase, where we left off the last time we did this webinar, was in April of 2013. And on this particular slide that I'm showing you here, I put a little note about something called option defense barriers, halting the rally right before the magic number of 100. All right. Option defense barriers are something that you as currency traders need to be aware of. They are out there. You can Google option defense barriers. You can Google exact options. You can look at websites such as Wikipedia for more information on options that are used by large central banks, specifically China. And what they do is they will play for price staying inside of a range between certain prices, and they will use their massive currency reserves to make that happen. So whenever price was approaching, back in April of 2013, whenever the dollar versus the yen was approaching parity, or 100, which is another way to say it, parity, there would be massive selling. Excuse me. And it would be by the person or persons who were defending that 100 barrier. And the goal, of course, was to keep price from hitting that 100 barrier until the expirations of those specific options in order to capture premium. So you have a buyer of an option, you have a seller for the option, and the one who's trying to keep the price from hitting that barrier is trying to capture the premium. All right. Question from Jason: what are the underlying assets for those options? Well, actually, Jason, the question is very good. There are exotic options on currencies. There are exotic options on stocks, individual stocks. You could actually find exotic options on commodities such as gold if you can find a broker that will take that trade from you. But as a retail trader, that's pretty difficult to do. And there is a lot of information out there on the internet about exotic options and how they work and how countries like China will actually take a bet where they say that price will not hit 100 before a certain time every day in New York, and it's usually around 10 o'clock in the morning in New York time. And as long as price doesn't hit that barrier, they get to keep that premium. And I don't know who would want to take the other side of a central bank. They seem to have, especially if it's China, lots of currency reserves that they could use to defend the barriers. All right. Yeah. So do a little bit of research on those exotic barriers, and keep in mind if you're trading assets such as the British pound versus the U.S. dollar, if you're trading the euro versus the U.S. dollar, look out for the round numbers, look out for the figures, look out for the halves. So, for example, in the euro, if you're anywhere near 139.5 before 10 o'clock in the morning, New York time, there might be some selling. All right? Just something for you guys to understand as supply on a chart that you may not even see. All right. So, moving right along here, we had several attempts to penetrate that barrier, and this is the week of 4/17 last year. April 17th, we got very, very close to 100, and price fell. We came back up there, and we challenged that 100 area once again the week of 4/24, and we're very close. And all it takes is for one pip above that barrier, and the barrier is violated, and the option bet is lost to the person that wrote the options. All right. And once again, the price failed to reach that critical barrier. Of course, at the same time, the pattern that we teach our students to look for, where there's indication of institutional selling, prices rally here, they base for a period of time, they drop, they come back to that area, they test that area again, there's still more supply, still more institutional selling. Only this time, even without knowing what the events of the world were at the time, we can assume that there is somebody up there with a large barrier that's trying to keep price from hitting that 100 barrier. Now, of course, once price does finally hit that barrier, the person that's been selling dollar yen to keep price from hitting that barrier is going to have to turn around and buy to cover their short positions, and sometimes that can lead to a massive push through the area. All right. So that'll happen occasionally once in a while too. Let's see if I can do a pointer tool that you guys can see. Hopefully you can see a pointer tool now, because these are pictures that I posted onto a chart here. And I've tried drawing on these charts occasionally, and a lot of times they don't draw very well. So even with the pointer tools, but yeah, we were right here at just about the breakout through the barrier option. Okay. Yeah, I tried putting on a drawing tool, but unfortunately, let's see if I can try it again really quick. There's a little pointer here. You might be able to see the pointer, but I don't think you'll be able to see it once I come up to where the chart is. All right. So we'll try to kind of point these areas out on the chart as we go along. So we were in the area here where we were just about to, once again, try to take out this barrier. We're at 99 now. We're failing every time we get up very, very close to this area near 100. And finally, on the week of 5/11, price finally breaks through the 100 barrier. And when price finally broke through the 100 barrier, came out on the other side of the 100 barrier, we started to move a little bit aggressively into a very large area of supply, which went back all the way from, I believe, 2008 at this point. We're starting to test areas where we have supply from the crash that we had back in 2008. So let me just jump ahead here just a little bit. There's a couple of slides here. All right. So we have now also, okay, I'm not actually pointing at anything on the chart right now. When I do point on something on the chart, I'll do my best to yeah. The white arrow point, yeah, as soon as I get on the chart, the arrow disappears. So I don't think it actually is going to allow me to do this unless I try maybe a little pencil here. Yeah, trying to draw on the chart's not working out very well either. Yeah, unfortunately. All right. Sorry about that. Where we are, though, at this point, is a kind of a critical point last year in the markets. And that is the week of 5/23 when the Nikkei 225 in Japan begins to sell off. And the Nikkei 225 in Japan began to sell off due to rising interest rates. And when we talk about rising interest rates, we're talking about 1/2 of 1%. 1/2 of 1%. That's all interest rates rose back in Japan. And it caused a massive sell-off in the Nikkei 225. It began the week of 5/23. And as it began, what happened was the Nikkei began to fall rapidly. And on 5/24, the Nikkei futures were down 310 points. And we were falling very rapidly due to fears of rising interest rates in Japan. They were worried that the market, which was up close to 70% at that time last year, was actually overheating. And so the news was the rising interest rates in Japan was causing a massive sell-off. Well, at that point in time, of course, I'm now tracking the Nikkei 225. I'm going to start tracking the Nikkei 225 going forward from there. And the reason is because I noticed a correlation that every time there was a rally in the Nikkei 225, there would be a similar rally in the chart of the dollar versus the yen. And every time there was a sell-off, obviously, there would be almost an identical sell-off. Well, as you probably know, there are traders that are going to go long one asset and simultaneously short another asset as currency traders. When you trade a pair like the dollar yen, if you're long with dollar, US dollars, you're short Japanese yen. And so there are traders, though, that will short Japanese yen as part of something called a carry trade. And they'll use the carry trade to take money that they generate from selling Japanese yen and invest it in stock indexes. So there's a lot of traders at this point in time who are long the Nikkei and short the yen. And the reason that that's a problem is because when everybody's already on board the ship and they're all standing on one side of the ship, it has the potential for the ship to tip over. So it's something we have to keep an eye on because if you're looking at this chart that I'm showing you from 5/25/13, you'll notice that there is a red candle now. The last candle on the chart on the right side of the chart, there is a red candle. And that red candle is the beginning of a sell-off that is actually going to take, over the next few months, it's actually going to take the dollar versus the Japanese yen from around 103.45 down to the demand level that you see, the second demand level down below at around 94.43. Now, I want you to notice that these demand levels, the two of them, the one for The closer one, which we call the proximal demand level, at around 98, 92. All right. And it's, again, a level where there was a strong rally. So therefore, we assume that there will be unfilled orders to buy, dollar versus yen at that point. And of course, below that area, we have a very strong rally, the origin of the rally that takes us to the recent highs. And that area between 94.43 and between 92.62 or 92.67 is what we call our distal area of demand. And it's kind of important at this point that you guys understand that according to the way the core strategy we use works, the market can go up, it can go down, it can go sideways. At this point in time, ever since the breakout into the bull market phase around the beginning of 2013, we believe the trend is now up for the dollar versus the yen. The cyclical trend is up. We're also looking for areas of price supply in the past that's going to slow down this rally. And we're also looking for areas of demand as they form below current price that's going to support the rally. And at that point, below 92.67 is a pretty critical point where the market could go all the way back and possibly retrace the entire rally. And I know there's a lot of people that do Fibonacci analysis. You can kind of, in your mind's eye, I don't have Fibonacci's on this chart, obviously. I personally don't use them. In your mind's eye, if you were to put a Fibonacci retracement tool on your chart, you would probably see that some of these areas may actually line up with key Fibonacci levels. And if they did, you would expect anybody using that analysis, especially people with large accounts, defending those areas, the 23, the 38, the 50, possibly the lower ones also. But for us, if we break through 92.67, we're probably going to retrace all the way down to the 86 demand level. And by that time, now you have to really even question if the trend is up anymore, or if there's a chance that we're going to go retrace the entire trend. And then this was just one big market cycle. And that's a huge area. So keep an eye on this 94.43 area as we go along here. Because it's kind of critical that the price of this asset stays above that price going forward. Well, when we start to fall away from this 103.65 area, we start to form supply levels above current price. And the first one forms between 102.46 and 103.65. And these are areas of supply that are forming due to something called rising yields, JGB yields. The bonds in Japan are called JGBs. And of course, that's what you'll hear in the press. This is what you're going to hear preached, why the market in Japan is selling off, all these reasons. Institutions love it when there's good news because it will drive price all the way up to where there are supply levels. Institutions love it when there's bad news because it'll drive price down to where they have large unfilled orders to buy. Institutions will just respond to the news by taking advantage of the moves in price. And so now we've kind of given ourselves a little bit of a trading range between the area of 102.46 up to 103.65. And we formed a little area of demand, 101.06 to 100.61. Notice also we have a level that on my daily chart, because I'm showing you weekly charts and daily charts, we have a little level of demand also at around 99.05 down to 98.52 at this point. So in the next week or so, we have a little bit of a rally. And we're back to the weekly chart the week of May 28th of 2013. And by this time now, most of our students are taught that if we start to form areas of supply above current price, we want to try to trade two-sided if we can. Obviously, try to trade long near the areas of demand that we've marked off on our charts and simultaneously start to sell rallies into the areas of supply that we've marked off on our charts. And so on weekly charts, daily charts, these areas will form. The patterns that we teach at our academy are fractal. So at this point, it's looking like a weekly supply level is beginning to form. But there's really not very much room for price to fall before we hit a demand level. And that's one of the things that when you start to trade using demand and supply, you have to be aware of. It's called profit margin. And if you don't have a profit margin, sometimes it's a good idea not to take a trade. But as we move on to June now, we're in June, the first week, and we formed now 2 daily supply levels above current price. We briefly had a daily demand level on 528.13, and 2 days later we crashed through that level. And that's one of the things that students will struggle with. They will look at the patterns that we teach, and I'm sure Sam has pointed this out. When we say profit margin, we say profit zone. You have to have room between your levels so that you have room to have at least a minimum of 2-to-1 reward to risk on every trade you take. And if you don't have 2-to-1 reward risk on every trade you take, or if you trade levels that are pretty much stacked on top of each other, when the market does finally switch from bullish to bearish, as on the daily chart it is now, you're going to have areas of demand that's going to get smashed. It has to. When the market finally bottoms, the opposite will happen. You'll have very close areas of supply that have to be eliminated so that the market can reverse and go back the other way. So something that's really critical to what we teach and how we teach is make sure you have a profit every time you get ready to take a trade, and try to buy your demand levels as far away from supply as possible, and try to sell your supply levels as far away from your demand zones as possible too. And be aware that if you happen to take a trade on one that's close to where the market wants to reverse, make sure you use your stops, because you can and will get stopped out pretty quick, as was the case right here. A demand zone was taken out in 1 or 2 days. All right. So price now falls pretty quickly down to the area of demand at 99.05. Now 99 is a round number, just like 100 is a round number, 101, etc. At that point, there could have been option barriers at 99. There could have been a battle between certain institutions that are long the options and the other institutions that are short the options. But at this point, that candle, that big red candle that comes dropping down directly into that area at 99.05, it really had room to fall. And when it got to 99.05, it stopped, because at this point now there are some orders to buy. And all I can say is the logic behind what we say there are orders to buy is basically if there were no orders to buy at 99.05 and nothing between 99.05 and 98.50, we would probably fall quickly through the area and work our way down to the next area at 97.48, down to 97. So we're stopping for a little bit here, but let's see how long we stop for. Well, as it turns out, we stopped for a day. We hit that area, and we bounced off that area. And we next day had a little tiny rally. You could see a little green candle above the area of 99.05. And notice on that green candle, in between the red candle where we actually bottomed, we managed to rally close to 150. So now we've managed to bounce a pretty significant bounce from 99.05 to 150. So now if you're somebody that's short, and believe me, there are a ton of people that are, and they're shorting the way that we teach our students to look for, which is basically the price is falling, they're selling, period. And it could be because they see 2 down days and they sell the third day, or it could be whatever type of technical analysis they learned. Momentum just continues and nothing stops it and all that other stuff. And we don't believe that at all. We believe that their price will fall to where there are pockets of orders to buy, and it's just simply which already becomes zero at that price level at that point. But we immediately, the third day, crashed right back into this area. Now we're down 4.66% from the highs of earlier in May. And we're down pretty quickly, but at the same time, the Nikkei is falling significantly also. All right. So which month am I talking about? I'm talking about the chart we're looking at here, the 3 days. The date of the chart is 6/3/13. And the 3 days that you see where we came into the demand level on this chart, and that was the beginning of the day on 6/3/13. And it's more or less what I call an afternoon chart. I marked on there an afternoon chart. So we have the morning chart where we're way, way above the area of demand at 99.05. We're actually looking to test this area of 171 supply right here at the high that day. And then we fall, and when we fall all the way that day down into this area of demand, all right, at 99.05, so that's still the same day. The next day, this is probably not 6/3, this is probably 2 days later, 6/5. So I'll just mark 6/5 on here, because 6/3 we hit the demand zone, and 6/4, which is the green candle in the middle, we bounced, and on 6/5 now we've hit. All right. So I'm showing you the chart that hopefully everybody can see it beside Arnique. All right. Can you guys see the chart that I'm pointing at right here? There are 3 charts right here. Yes. Do me a favor and type yes in the chat if you can see it. Yeah. Okay. At the left middle, there's a chart right here that says 6.5 dollar yen. Yes, we see one chart. Okay, so let's go back real quick. Let's go back to the 2 charts before it. This is chart number 1. Everybody see where it says 6/3/13 dollar yen morning chart? Okay. Weekly Forex. There is only a weekly chart? Well, this whole presentation should be showing you charts. You're seeing the trade station? So you're not even looking at the right monitor. Hold on a second. Oh my gosh. I'm sorry about this, folks. It's just crazy. It's really crazy. I have it on the wrong monitor. Yeah. How do you think I feel? This whole time, what I've been doing is doing this. I've been going from one chart to another chart, and when you say you're briefly seeing my pointer, it's because I'm briefly flashing my chart over to, wow, horrible. All right. These are the charts that I've been showing you guys, and I'm trying to point out the areas that we were talking about. All right. You see it scrolling now. Okay. So let's start here at 525. This is kind of the red candle I was talking about, and everybody should be able to see a red candle, the last candle on the chart, all right? And at that point, you can see 2 areas of demand, 98.92, and one down here at 94.32, which is what I thought you guys were seeing before. So I apologize for that. just wanted to point that out. Remember, below 92.67 is where I'm worried that this market is going to top out. And if it does, possibly retrace most, if not all, of the gains that it made. So then I move on to the next chart, and I can show you on the daily chart now that you're looking at, which is dated 5/28/13. You could see that the market has rolled over and created a daily supply level due to the news the yields in Japan's interest rates are rising. All right? At that point, we've also created a tiny little demand level between 101.06 and 100.61. And what I'm trying to point out about that is that this demand level between 101 and 100 doesn't last very long. It goes away rather quickly because the market has now, in the short term at least, turned bearish along with the Nikkei. So then we get to this chart here, and the weekly chart, 5/28. We're not anywhere near the demand level at 98.92 on the weekly chart, so we're still close to the highs of the year at this point. And on the next chart, what happened is we fell in the first week of June. We started to fall towards this 98.92 demand level on the weekly chart. So the markets are becoming a little bit more bearish. Now, these three charts here on June 3rd, we actually are starting the day near 171. And that's that little demand zone that I mentioned to you guys got taken out pretty quickly. It didn't last but a day or so. And the markets pushed through the demand level. And now we're getting ready to test this demand level down here at 99.05. So in the beginning of that day, we're near the highs of the day. During the day, we fall directly into the demand level at 99.05. And we're inside the demand level. And we actually rally out of the demand level by the end of that day. We close above the demand level. And the next day on 9/4, we actually have a rally that goes all the way back up to close to 150. All right. Why was there no buying at the demand zone? Well, there was plenty of buying at the demand zone. What this indicates is that when price hit the demand zone on 9/3, there were enough buy orders to stop it from falling below 98.85. On 9/4, you actually had a rally that went up to about 129. And then on 9/5, you started the day very close to the highs of the day, near 100. You pushed as high as 129, almost 100, maybe closer to 50. And then by the end of the day that day, on 9/5, you are back in the demand zone at 99.05. So there was plenty of buying in the demand zone. There was enough buying in the demand zone for a rally of about 150 pips. So, but the point is, at this point, is this demand zone going to hold, or is price going to push below that demand zone? And as it turned out, price rallies out of the demand zone, and now it's coming back down to the weekly demand zone, which means that 99 demand zone on the daily chart didn't last very long at all. It only lasted, in fact, for a couple of days. All right, so here we are bouncing around inside this area between 99.05 and between 171, which is typical. Now it's a contest between the buyers and sellers. Are we going to take out the demand at 99.05? Are we going to go down and test the area down at 97.48? Or do we take out the supply between 171 and 101.74, and which means we would then test the supply area at 102.46. All right. As far as aggressive trading versus conservative trading, Jason, if the orders are that close to each other, if there's demand this close to supply, it's typical to see several days of the institutions just taking price down to where the buy orders are and up to where the sell orders are, and you have sideways candles, and they get smaller and smaller sometimes, and eventually one party drops to zero, and you go down to the next big area of buy orders or up to the next big area of sellers. Really, for you as a trader to stay out of, well, I don't know. I mean, personally, if you can afford to take risk, and you may want to enter on a smaller time frame chart, but for my style of trading and for what I'm showing you here, these are all daily, weekly charts mostly, occasionally a 60-minute. You can always go to a smaller time frame chart and look for a demand level inside that daily level on maybe 15-minute charts, 60-minute chart, whatever you like. And you can reduce your risk significantly, and you can trade long and short. I mean, there's no crime in just buying at demand and selling at supply if you know how to do it. My problem is always this way, swing trader, interdater, crossover. Yeah, it gets to be that way for most everybody. And then when you start to think, well, we were bullish all this time and now we're bearish, and should I be buying or selling? It gets to be complicated. But it's something that you keep working on. Well, at this point now, we're on the week of 6/9 of last year, and we've actually pushed all the way down. We've pushed all the way down to the demand level near 97.50. And when we got to that demand level, that didn't last very long at all. As a matter of fact, that level got pushed through like it wasn't even there. Price went all the way through the level, and now we're down 8.38%. And, of course, at this point, I'm going to say that I could go back to my blog. I could look for it specifically that week, which is one thing that is nice about the way that I do this blog, and I do it every week. And what I try to do when I do the blog is I try to keep track of what exactly happened every one of these weeks. And, of course, you can see from just looking at this chart on June 5th that we were having some issues in the U.S. stock market as well. We were having some selling in the exchange-traded fund for the S&P 500. So the whole markets are bearish. The Nifty was having some selling and was actually testing a demand level at that point in time. Even our bond market was very bearish at the time. The wheat market was rallying a little bit. These are the assets that are on my blog. I have a stock called Akamai Technologies, which is breaking demand zones because the market has turned bearish in the short term. And here I have the chart of the dollar versus the yen that we just looked at, and the news in Japan as to the success of Abenomics is flowing in from all parts of the world. BMW and Fiat reported strong sales of luxury cars in Japan as consumer confidence returns due to the 30% increase in the Nikkei 225. And Toyota Motors is benefiting from the weaker yen as exports grew in the U.S. and Europe. And hedge funds in Japan are riding a small cap rally, with one fund gaining 71% through April of 2013. Other funds reporting gains of 39 and 51%, as Japan's hedge fund index gained 18% as of April of 2013. Yeah, well, I'm sure you've had other seminar participants on here that just shake your head like I do when I hear about printing money leading to prosperity, but it seems to be the way that all countries are going. Reminds me of beggar thy neighbor. Yes, I have a question. Do I follow the Indian markets too? Yes, I was in India in 2012 several times, working with instructors in Mumbai and Surat, and actually training those instructors to become instructors for the Online Trading Academy using core strategy. And I follow the Nifty every week, and I have since May of 2012 on my blog. Congratulations to the all-time highs. It only took a few years from 2010 when you topped out, but you're there, and good for you. And hopefully you learn how to protect those gains so you never go through another bear market like the one they had in 2010 and 2011 and 12. All right, so I'll tell you what, folks, and I really apologize for that, but it's not like we really missed anything. Anybody who's watching this webinar and the recording, if you just kind of watch it, you're just going to see that what's been happening during this period that I'm describing in June and May of last year was our markets, the world markets, had rolled over and pretty much began forming supply levels on our dollar-yen charts. And as they did, they took out several areas of demand. And we actually working our way now down to the area of demand that I consider to be critical. The area down at 94.43 on the weekly chart, this area of demand has to hold, or now we have the potential for a complete reversal of this trend. Of course, at this point, I believe that the market will bounce here. And what I actually believe is going to happen is we now have an area of demand between 94.43 and an area of supply between 129. And we're probably going to go sideways. And we are going to go sideways until we finally broke out of this area in December of last year to the upside. And we began the next leg of the bull market higher for the dollar versus the Japanese yen. But here we come down to the daily demand zone on June 13th, and we get extremely close to 93.54. But because we are hitting the weekly zone, which is actually closer to 94.43, we never quite get to 93.54. And the market begins to bottom, and it begins to reverse on June 17th. And June 19th. And we begin to rally from there pretty strongly by June 20th. We're having a pretty strong rally now from the weekly demand zone. And the weekly demand zone is actually right here between 94.44 and 92.45. And as you can see, that green weekly candle, we bottomed the previous week. We're now rallying this week. And that's what begins the sideways trading and the official sell-off at that point now from the highs of 103.67 down to this area, 94.45. We're down pretty close to 10%. 10%, by the way, would be the definition of a correction, and 10% would be something that they did in Japan. They were down over 20% at this point in their stock market. So the dollar-yen pair has given up 10%. The Japanese yen, of course, has rallied strongly, which is counter-trend at that point. But one last slide that we're going to go through here before we move back on to we'll pick this up again with part number 4. And this is not unusual, by the way, because this is stocks, and there's my treasury markets, and this is our commodity called wheat, which of course everybody has. And these are the levels in the wheat market. These are the levels in the stock called Akamai Technologies, which, by the way, had fallen over 17% from the highs of the year in a short period of time. And here's our Japanese yen in this last chart, and we'll pick it up next time. The selling in the yen seems to have slowed since the dollar-yen tested the weekly demand on 613.13. Prices based for the last 4 trading days. The Nikkei is now based between 13,447 and 12,475 for 11 trading days, meaning that the heavy selling has slowed in Japan. So at this point, it's just where we're going to end it here. We're going to end it at the very end of June. We'll pick it up again for next month's webinar. All right. But at this point, since the yen has weekly demand and supply to trade between, this should be the range for both the trade long and short for anyone looking to trade a sideways market. Anyone long from lower prices, a position trader should have a stop loss below the weekly demand zone. Most of the currencies are range bound except for the Aussie versus the dollar pair, which entered a downtrend phase on the weekly chart. And the pound dollar pair looks like it may trend higher on the weekly chart since the economic data in the UK is improving. All right, so it's 7:46. We're going to cut it off right here. We are going to leave it on this end of June, all right? And that means that we will pick it up with our next market cycle review beginning in July of 2013, and we will continue to move forward from there. Appreciate all the questions. I know some of you are great questions here. Continue to send them in or send them to smisic@tradingacademy.com. And as far as the presentation materials, they're actually part of Online Trading Academy's materials, so I'm sorry, no. I can't pass that out. All right? Other than that, folks, I hope you had a good time. Sorry for the mix-up here as to which monitor I was showing you guys. So we'll try to straighten that out for next time. Thanks again, FX Street. Thanks again for everybody for attending. Have a great day, and see you next time. Take care.